Building Blocks, 2025 in Tel Aviv, the future of tech.
Hey everybody, I'm Mark from Fuse. We're doing a panel about stablecoins. I will ask you guys to join me on the stage.
Tomer Weller, Jones Kern, and Omer Paz, please join on stage.
So I think stablecoins have got really exploded in the last year. I would say maybe in the last 2 years. But if you remember, 3 years ago there was a big scare, and Terra Luna was exploding, and the whole stablecoin space were basically non-existent, I think, at some point in history. So I think we're now sitting to talk about it and what changed. And let's start.
Yes, stablecoins. Woo!
Woo! Okay, so let's start with presenting. Each one present your stablecoin and tell us a bit about your background. Omer, do you want to start?
Sure. So I'm here representing Bits of Gold. We're building the first ever ILS-pegged stablecoin, Bills. We're doing it in a very and highly regulated oriented framework, very similar to what Circle is doing with USDC. And we're hoping to push the local ecosystem into onboarding more blockchain applications, trading with crypto through stablecoins, and enabling more and more use cases locally with the current ecosystem.
Hey, I'm Tomer. I lead product at the Stellar Development Foundation. Not exactly an issuer of a stablecoin, but Stellar is an L1 blockchain, been around since 2015, really focused on financial inclusion, and the original use case was payments. And so stablecoins, or back then we didn't even call them stablecoins, it was just reserve-backed assets, are kind of like a basic primitive of Stellar. We have a lot of stablecoins issued on Stellar. And yeah, happy to get into the use cases.
Hi, I'm Johannes from Switzerland, and what we do have in Switzerland is we have really good chocolate, we have a really good cheese, and we have a really stable currency. So that's what we're building. You know, we're bringing the Swiss franc on chain with Frankencoin. It's one of the largest, actually the second largest non-euro, non-USD stablecoin actually currently live, and you know, just putting out an alternative to the dollar. That's what I'm here for.
Is it live on Ethereum?
It's live on Ethereum, it's live on Base, it's live, well, all across EVM chains, yeah.
What about Stellar?
Not yet. Should we put it there as well? First business of the day done.
One deal done. Nice. So let's talk about the pains that stablecoins solve. So we're trying to maybe focus more on use cases. Let's start with you, maybe, Johannes. What pains stablecoins solve, and for who?
Sure. I mean, I believe stablecoins have some kind of two types of functions. One is transactions, you know, being able to pay with it, being able to use it in your everyday life. Which, for example, we do it. You can use the Frankencoin in one of the largest. You might have it here as well, Spar, the supermarket chain. So you can use your Frankencoin to pay in Spar in Switzerland. Gnosis Pay is doing a really cool job there as well, just, you know, payments and the transactions. And the other one I would say is store of value, because you know, being in crypto and more people are living on chain and having a big chunk of their wealth in the digital world, and you might want to de-risk. You might want to have less volatile assets in your portfolio at some point, and that's where stablecoins are the obvious choice, right? Just to de-risk and to not have to worry about 100% plus annualized volatility.
Yeah, so I think first of all we need to acknowledge a harsh reality, which is that the main use case and the main product market fit for stablecoins right now are to drive speculative investments. And so what we're seeing on chain is, you know, at the end of the day, people are, you know, on-ramping through USDC or whatever. They go to Solana, they buy a Trump coin. We can not like it, but the reality is that this is what's happening. So there's a lot of that. The vast majority is driving speculative trading. But I do think that what's unique about the last couple of years is that we're starting to see product market fit in the non-speculative space. So definitely in the store of value, we're seeing a lot of adoption in Argentina, where there's a huge issue with inflation. People are really attached to the dollar. People live the exchange value of the Argentinian peso to the dollar day to day. So we're seeing people get their paycheck and immediately go to like a dollar-denominated account, and more we're seeing this happen in stablecoins and non-stellar, specifically with USDC mostly. I think that we're also seeing some communities in kind of like less served areas, like rural areas of Colombia, that are able to accept payments, like gig economy payments in US dollars from the US using stablecoins, which is awesome. We've been working with the UNHCR refugee organization on delivering disbursements to refugees in Ukraine using stablecoins, and it just so happens to be that the coverage of on and off ramps for these stablecoins in these areas is actually much better than some of the banking infrastructure. So on Stellar, we have, for example, MoneyGram active. MoneyGram is a huge global kind of like financial institution, and they're able to turn USDC into cash, USDC on Stellar into cash and from cash, and like 400,000 agents around the world, including places that are like war-ridden, places like Ukraine, even Israel. Yeah.
Do you have a way of knowing like which country has the most like real world usage, like where people actually use it as cash?
In terms of actual like peer-to-peer cash, very little usage. I think what we're seeing is like the cross-border usage, and it's the payout use case. At the end of the day, what we're seeing people do mostly is just keep it around on them and then able to on and off ramp as needed. So I don't think, like I'd love to be, we're working on a lot of this, but I'm looking around in the industry, and the peer-to-peer story is not quite there yet.
So I agree that by now what we see is a lot of speculative trades using stablecoins, because that's easy, and everybody wants to, like early adopters always goes to the places that it's easy. But
Greed attracts.
but where stablecoins do come handy are in places where the market are not good enough. So the access to the market is not well integrated with all the financial instruments that you need in a very good financial ecosystem. So that's where stablecoins can come in handy, like in places where FX trade is more expensive, okay, and you can do that on chain in a very in a cheaper way. In places where creating a payment or initiating a payment from one place to another country, like cross-border payments, where it takes sometimes days to get the money, and by waiting for the money to come, you get inflation and you get reduction, of currencies and stuff like that. And by the end, when you get the actual funds, the funds that you get are not even worth the wait. And I see that. I spoke with the guys from Deal. A lot of the trades and the transactions that they are doing are to countries where the inflation is very high. And by the time that they get the payment for the salary that they need to send to for Turkey, for Argentina, and the inflation goes up, and they don't have enough money to send to the employee on the country. So they have to edge themselves against the inflation. So that's where stablecoins can come in handy. Another place where stablecoins can actually solve use cases and they don't. Okay, like for now we haven't saw that enough, is actually making our money smarter. So for example, in Israel, let's take the use case of the governments want to pay out the mefunim in the north.
Evacuees.
The evacuees in the north, they want to pay out for them severance pay. And they want them to be able to pay it only to approved supplier, to whitelist suppliers in the government. So the best way to do that and the easiest way to do that is through stablecoins and smart contracts.
Is there even a way of knowing like who use it for what? Like, can you track it? Like, do you have information about a transaction that somebody does in Lebanon? Can you even tell that this is Lebanon or Africa?
There is a way to onboard a user and to allow user to go through a KYC process where, in the traditional financial ecosystem, banks and other financial institutions taking their users and making them go through a KYC process. We can do that also on chain.
Yeah, I'm just curious because you see a lot especially after the war in Ukraine, you see a lot of people in Russia and in Ukraine suddenly all of them know what is Tether. Like you won't meet anybody from that part of the world that doesn't know. And also Tether did $1.5 trillion in volume. So some of it probably is people in Russia. Some of it is people in Argentina, in Venezuela, in Turkey, in Lebanon, that they don't have a local currency. I wish we had a way of knowing like who uses it for what.
But isn't what you're just saying the complete opposite of the ethos of permissionless blockchains, where you don't want to know that, and you basically it's.
I think permissionless blockchains are a threat on country model, on the state model, on tax collection.
Is it, or is it more making it fair? Where me being Swiss, I think I don't know many Swiss people who don't like to pay taxes. Isn't it more you put the leverage back into the hands of the people instead of basically the governance being able to extract value and basically lock in? I mean, one very good example is Lebanon here, where many Lebanese people, especially wealthier Lebanese people, they would hold their assets in dollars because they wouldn't, believe in the Lebanese pound. However, in dollars on Lebanese banks. And then capital controls came in, and those dollars were only worth, 20 cents on a dollar. And that's exactly what you can avoid with crypto, where and that's actually a big use case in places like Argentina, Venezuela, all those places you're mentioning as well. And that's why I would basically argue exactly against what you just say. You don't want to use. I mean, you can technically use a whitelisted stablecoin which can only interact with KYC people. But this is the Chinese model where you have credit score, where you basically give more power to the state.
Yeah, I'll just add. I represent an L1 blockchain. We definitely are not interested in policing the network, and so I do think that at the end of the day, and I'm with you, Johannes here, I think that at the end of the day, it's up to the applications, and it's up to kind of like where the rubber meets the ground in terms of on-off ramps to kind of like try and work with the users and understand when needed, based on regulation, what is the source of funds. But I have no interest in having an overall graph of the network and understand exactly what every transaction does. At the end of the day, we have the Chainalysises of the world that are, doing work that unfortunately has to be done. But as a network, I don't want anything to do with that.
Do you think this is the way things are going? Like this is like this would happen in the future? What do you see stablecoins 10 years from now? How do you see, what would they replace in the world?
Banks.
So it's very hard to say 10 years from now, but
let's do 5.
Yeah.
Five is like in our day of age, 5 is like the new 10.
So I would say that we're going to see much more local stablecoins going out. I would say that we're going to see a lot of banks issuing their own stablecoins. And I would say that we're going to see a lot of regulation in place in terms of stablecoins and less free market, like less free decentralized stablecoin, anonymous type of a market, because the local stablecoins will make it so that the people when want to onboard to the stablecoin and offboard, because of the local regulations, they will have to identify themselves. And we will see less anonymous transaction and more, or maybe on-chain it will look like anonymous, but the reality will be is that people that will actually want to off-ramp, we will know who they are and the source of the funds, and we will have a good tracking of where the money came from and where is it going to go. And that's essential for, in my opinion, that's essential for us to maintain an ecosystem that actually pay taxes and actually, contribute to the country. Otherwise, we're going to see a lot of, black market activity that we see already in Tron with Tether and,
But once again, I mean, this is me, the Swiss speaking. Maybe I'm not sure how it is in Israel. If you have to have all this in place that people actually are paying taxes and not basically going somewhere else, is that not a problem of your system, where people don't feel that they're getting their money's worth, that you have to force them to do that? And do you want to live in a system where you have everything tracked? Once again, a Chinese system, like the credit score. Do you really want a system where everything is controlled, where the state knows everything about you, and where they basically, it comes with things like, just being able to freeze you?
But that's the reality.
Yeah, you know that a few years ago, Switzerland was like the secret place you would keep money. And it's not
very much worse of that.
Yeah, and then America came and somehow said, okay, either you stop with that secrecy stuff or we'll fine you. So Switzerland is no longer like the secret banking partner. It's actually the opposite. It's like a super transparent now.
Yeah.
So my question is like where the line is. 5 years from now, if everybody use it, to me it sounds like it needs to be KYC. How do you see it?
Yeah, I think that my view on this is that stablecoins are going to be mostly in the back end in the future. So I don't think that the end user is going to have any idea of the fact that they're using a stablecoin for the most part, or what stablecoin they're using. At the end of the day, when I make when I make a credit card payment here, it's not that I know that my my dollars in my Chase bank account are Chase dollars, and they get swapped to Visa dollars, and at the end of the month, the Visa dollars get distributed to whatever other bank dollars the merchants use. So at the end of the day, we already have these kind of like reserve-backed assets right now, but we're just like not calling them what they are, and the interop story is terrible, right? And so at the end of the day, stablecoins are just improving the efficiency, improving the interop story, and they're also making it accessible for a lot of communities that don't necessarily have access to these advanced financial instruments, because we are seeing, especially in some emerging economies, the lack of financial infrastructure is making like self-custody infrastructure really big. And so with this kind of like baseline of stablecoins, I think people are just going to start seeing them as like a checking account. So at the end of the day, the same way that checking account is the basis for all kind of like modern financial modern like banking infrastructure, the stable coins are the same thing for the on-chain economy. So people are just going to have dollars, or they're going to have shekels. They're not going to be interested or care about who the issuer is. That's going to be a back-end thing.
Let me basically, I completely agree with you, but let me pose it or phrase it a bit differently. What I am building towards, and what I think is the big thing, because as you said, already they're not called stable coins, but you have those, if you have money with the bank, basically it's a number in a database, nothing else. And what I see, and what I hope in 5 years, that this all becomes optional. So yes, you can choose to go with a bank, you can basically go all through that, but right now what you have is you are forced to. Right now you're depending on a bank, because there's no other way you can access the financial system. So, and banks are attracting a lot of value out of that. Basically, you don't control your own money. Now, what I believe, or not believe, what I hope we're building towards is a system where you can still choose to have a bank. If you believe that the bank adds more value than it takes, being it in security, being it in user experience, be it in anything, but that is optional. That I also have the possibility to say, I don't need a bank, I have my wallet, I have self-custody, I have my own coin, my own keys. You know what I mean?
But even in this world, you think that a future self-custody wallet, one that has, you know, mass appeal to like normal human beings, they will present their users with options of like what flavor of the Swiss currency I want?
No, it's going to be abstracted away, but I still have the option. If I want to have that optionality, I can access it. While right now I cannot. If I don't have a banking license, I cannot access, you know, basically the central bank balance sheet. Yeah. And that's what we're changing with that. So yes, for 95% or 90% of the people, and I believe you'd be surprised how big the percentage of people is, especially financially literate people who want to have that optionality, which we've seen that right now with Revoluts, with all those neobanks, which are basically stripping away this bundled approach traditional banks have.
Revolut will also have a stablecoin.
Sorry?
It's interesting that a few years ago you had so many, like you had Facebook doing a stablecoin.
Yeah.
And then because Mark Zuckerberg said he wants to do a stablecoin, suddenly the government wanted a stablecoin. CBDC was born. And I think if Zuckerberg didn't want to do a stablecoin, we wouldn't have CBDC probably. My question is, you know, right now, should every company, like why Facebook can't have a stable coin, but every other company now, PayPal and, you know.
It's political, man. It's political. I'd say if Facebook would do the exact same thing now they've been doing 5 years ago, in this current political environment, they would have no issues.
Definitely.
So if they do it now, it would be okay?
Yeah.
Yeah.
Everybody, I think that most of the people in the industry know that it was political pressure that prevented them to actually launch a stablecoin. It wasn't their lack of will or you know ambitious.
Yeah, like on the topic of CBDCs, CBDCs are dead. The CBDC concept as it is existed for like many years is dead. Like no one is actually talking about doing you know, like siloed central bank ledgers and like
you need to come and speak with the
Israeli government.
Yeah.
Oh shit.
They just don't want the word blockchain. If you can find something that works like a blockchain but doesn't have the name blockchain.
Look, I have to admit, as Stellar, we played the CBDC game for a while because that is what governments wanted to talk about. They wanted like a very controlled environment. And I think that now people are realizing that like stable coins can be a controlled enough environment. And so what we're seeing is that the old concept of CBDC as like a siloed ledger is pretty much dead. The new concept of CBDC is mostly kind of like closer to the stable coins that we have today. And I think that a lot of governments are already realizing that, you know, if these things are so similar, maybe instead of issuing our own CBDC, we can just work and regulate the stable coins that operate in the country. And so I think that's what's going on in the States right now. Nobody's talking about CBDCs. And I think that's great. Like, good riddance, Baruch Sheptaranu, like CBDCs were a terrible idea.
I think people actually do talk about it a lot. That's the thing, you know. It's spread like wildfire because, you know, ideas proliferate. And they talk about ZK, zero knowledge proofs. They talk about, you know, they're trying to. In my opinion, the way you describe stablecoins is the way they describe CBDCs. The way you describe stablecoins 5 years from now is the same way they describe CBDCs as something. For them, which is consumer-facing, you talked about it, that it's behind the scene, but you're talking about pretty much the same thing. In my opinion, also the regulation will meet in the middle. So maybe it's time to talk about, you know, how stablecoins are used nowadays, because they're breaking, you know, they're breaking records right now of usage, and what are the risks of this exploding miserably like last time? Because, you know, we're waiting for something to explode.
I mean, fact is, most of what you would call stable coins, I mean, you said that yesterday evening as well, they're not really stable coins. They're, in German, there's this nice saying, Schaf im Wolfspelz. No, the other way around, Wolf im Schafspelz. A wolf in a sheep's cloth. You know, what we see happening, all those, you know, if you look at the largest growing stablecoins, they're all competing on yield. Where does yield come from? I mean, they're nothing else than, or many of those, they're just like hedge funds which call themselves stablecoins.
So I see from the local perspective, I see a lot of shift in the payment space. When we talk about stablecoins, we talk about mainly payment cross-border, and plenty of stablecoins. And we only see sprouts now of of local stablecoins that are coming up specifically because the regulation now allow it in many countries now, in Singapore, in Japan, even in Israel, the regulators are moving into allowing stablecoin companies to issue new local stablecoins. But we see it on behind the scenes. So you don't see it on CoinMarketCap or CoinGecko. You don't see the market cap, or you don't see the volume, because it's an internal coin for the companies who are issuing it. So, for example, Bilira in Turkey, they're processing over $1 billion in 2024. And Bitso in Mexico, they are doing billions of dollars of trade between US and Mexico. But they are doing it internally. They're not publishing it outside. So the usage of stablecoins is going to be locally. It's going to be processed by companies, and it's going to be transparent to the actual user. So the user is paying with peso or dollars or Israeli shekel or Swiss franc. But behind the scene, what's happening is actually a stablecoin transaction.
But isn't it just to onboard into dollar, those local stablecoins? Like
when you talk about dollars, yes, but when you talk about shekel, for example,
about
with bills.
Turkey, for instance, I would probably use Bilira to buy dollars, no?
I don't know. I don't know. Like I'm not a Turkish citizen, so maybe. But actually, the incentive for the local stablecoin companies is to actually build the ecosystem behind the stablecoin. So eventually, what our incentive is to make sure that in Israel we have a strong enough ecosystem that you can do whatever payment that you want. We can actually compete with the local credit card companies, with the credit card payment rails in Israel, and create an alternative payment rail for the local merchant. And it will be cheaper for the local merchant. It will take time. It won't be the first use case.
I mean, now we're back at payments, right? And this is a case which is we're as I said, like we're quite active on that side as well. The problem, I'm not sure how. What are average credit card fees for like merchant credit card fees in Israel?
Pretty low.
Pretty low.
But it's not like in America. Like it's less.
Yeah, right. Because in Switzerland it's I think 1.5% or something. And
it's still around 1 to 2%.
Yeah, but
it's not 3% like Stripe, and sometimes like 8, 9.
1.5% a pain enough for all those merchants to switch to stablecoins, even though that's like the question I'm posing. I'm a big fan of it. Like I would love to have to be able to spend my franco natively as I can with Spar. However, I am also a realist, saying that if you build a two-sided market, which this is, you have to fake one side. That's why I'm a big fan of players like Gnosis Pay, who in fact, well, the merchants still they pay their 1.5%, but you take out middlemen on the other side, and you actually, well, you don't actually take out middlemen, but you take out the bank.
I think that if you only save on cost, yes, it's not enough for the merchant. But if you also allow him to gain interest for stablecoins that he holds, and if you allow him to get the money to his bank account faster and not only at the end of the month, that those benefits will push him to adapt faster.
Don't get me wrong, I'm building a stablecoin, so I'm just observing reality a bit here.
Maybe you want to allow merchants to basically get 1.5% yield in stablecoins than to pay 1.5% to a payment vendor. Like replace one fee that you need to pay for yield.
Definitely.
Yeah, and I think that touches on, like I was talking about stablecoins being kind of like the checking account of the on-chain economy. But I think that now with the yield-bearing stablecoins and with RWAs in general, we're seeing a lot more kind of like savings accounts or high-yield savings account style instruments. And so, people, and this is part of the use case, like people are parking their value in stablecoin just to collect the 4 or 5% yield they can get from yield-bearing assets, rather, especially, and this goes back to the speculative use case, a lot of people are, during times of uncertainty, they're off-ramping from Bitcoin or from other currencies into stablecoins, and they'd rather get yield on a stablecoin. So that's definitely like a big use case. But, and again, I don't mean to deter anyone. I think that if you're sitting in front of the stablecoin charts and look at like these amazing numbers and think to yourself, oh, stablecoins are making it big time, no, it's still the speculative use case that's making it big time, and the stablecoins are just kind of like enabling that. But yeah, I think on the product side, the things that we're talking about in terms of like actually giving people that don't have access to financial instruments today access to these instruments, whether it's stablecoins, whether it's yield-bearing assets, I think that's the big thing. You were asking about the risks. I think one risk is that as long as these things are small, the governments kind of like are not actually paying attention. But as they're gaining more and more traction, and we're seeing mostly US dollar denominated stablecoins, the governments are starting to look at it, and they're starting to feel as their economy is getting dollarized, or there's a risk of it getting dollarized. And then there's a question of what kind of regulation we're going to see in order to combat that.
I definitely agree. I just want to add something else, that when we talk about local stablecoins and local economies, we're going to see specific use cases for each local economy that will fix specific problems in specific countries. So we're going to see it more and more, and that will drive local stablecoins further. And I definitely agree with the point, when I buy USDC and when I hold USDC or USDT or USDM or whatever, I actually invest in the US economy. And I think that's one of the bigger incentives for the US government to actually not push on the CBDC, but actually allow regulation to push stablecoin companies because they want to globalize dollar.
I mean, this is a super interesting case nowadays, the whole thing USDT versus USDC, right? Where USDT is, a global company, it's a Swiss, but ish, somewhat Swiss. But the USDC is now kind of the blessing of the US government. And it's basically, they're pushing hard against it. It's become a political fight because those two companies are so big. They're probably the two of the most profitable companies in the world. And now that's I'm just going to make the case for Swiss franc again, which is this alternative, right? Do you really want to, as you very rightly put it, by dollarizing it, you're basically exposing yourself also to the political system and to the economy of the United States? Well, fair enough. But I think there should be diversity in that as well. And that's where we, posed, hey, this is a little country in essentially Europe, and which has this outsized importance in TradFi. I think it's about 5% of the global currency market is Swiss franc, which is like completely outsized of the GDP of the state. But to have that option as well, exactly not as just transactional use case, where it's just convenient to have the dollar, but to hedge against your local currency, to go out and to get a yield on it and to store it.
Yeah, it also, when I told you about the Ukraine-Russia war, all of them know Tether. None of them knew USDC. That's also telling. There's a reason, we see much more usage on Tether.
And it's quite funny. I mean, Tether used to be dominating still is, outside of the US, but now with MiCA in the European Union, Tether is facing an uphill battle because kind of the USDC got the blessing of the state, if you will, of the government.
So if stablecoin yield is really attracting usage, and stablecoin usage is going through the roof, it's at all-time high. I think it passed the all-time high or something recently.
Every month is a new all-time high for stablecoins.
Yeah. Doesn't it mean that when Powell will lower the interest rates, we're facing maybe going back to what it was 3 years ago, which is non-existent? If they say yield is the new cashback, it's a way to attract customers, but this party wasn't always here.
Yeah, I think we're one thing that I hope to see in the future is that yield is going to come from like many different sources, not just from interest. And I think that we're seeing use cases around payment financing starting to happen, in which people and actually retail can put their money to use by these kind of like larger cross-border payment networks, because the entire premise of cross-border payments is that you actually need to finance in order to allow for efficient, fast cross-border payments. And so I do think that yield sources will start to diversify, and so they will be less dependent on kind of like the interest rate of the US.
So you don't think
Are
there's
they?
a systemic risk here?
But are they though? I mean, yes, Circle and USDT are, as decentralized stablecoins are, but if you look at all those yield-bearing stablecoins, are they really dependent on central bank interest rates? Because,
Which ones?
well, if you look at the USD 0++, the Falcon USD, all those funky high yields, stablecoins that popped up.
Guys, since we have 1 minute left,
Oh, shit.
I'll ask one somewhat spicy question. Let's see if there's a quick answer. Do you need a dedicated blockchain for stablecoins or
No.
RWAs?
No.
No.
I knew that this
It-
question
big
there
no.
would be disagreement.
In one sentence, in one word, no. In one sentence, basically every new chain is now is now claiming to be the new chain for stablecoin transactions, and yeah, there's no.
I'm expecting a different answer from you.
No, you're not going to get a different answer from me. I think, look, at the end of the day, we need to acknowledge the fact that this is like a multi-chain universe, and we have like different blockchains that do different things differently. I think that at the end of the day, Stellar was built for equitable access and everyday financial instruments, and so obviously stablecoins are like a big part of it. But at the end of the day, if you want to buy a shitcoin on Solana, you also need a stablecoin. So that's okay.
What we need is interoperability. Interoperability. I think that's a good answer.
And with that bombshell, thank you, everybody.
Building blocks. 2025 in Tel Aviv.